Hello traders, and welcome to this video analysis looking at the US dollar in today's markets. So traders, earlier this week on Wednesday, we had the Federal Reserve lower its interest rate from 2.25% down to 2% as expected. But at the press conference, the Federal Reserve Chairman Jerome Powell didn't signal that further rate cuts are coming and continued with the message that rate cuts is an insurance policy to make sure that the US economy doesn't fall into a recession or the global slowdown in growth doesn't start to impact the US economy. So we must remember, traders, when the Fed cut its interest rate for the first time in 10 years in August, it did it and it signaled it was only cutting rates as an insurance policy because of the US-China trade conflict causing global growth to slow considerably, and this would have a knock-on effect to the US economy because, of course, the US economy drives global growth and the US economy would not be immune to a slowdown caused by the US-China trade conflict. So clearly, traders, we know that the Fed is really going to be cutting interest rates based on how is the global economy performing, and that is going to be based off how are negotiations between the US and China going, because negotiations is going to have an impact on investor sentiment, and investor sentiment is going to have an impact on investment, and investment levels will have an impact on economic growth, employment, spending, inflation, so on and so forth. So if we're looking at the dollar moving forward, markets are expecting with a 44% probability that the interest rate will go lower next month, and then again around the same probability for a rate cut in December of around 50%, and then in January is the same, around 44% for a rate cut. So if the US and China trade talks go positively, then the expectations of further rate cuts will be reduced. And remember that in this scenario, the dollar will not weaken much further. So remember, against the Japanese yen, the dollar had been getting weaker because of these rate cut expectations, but now these expectations have subsided somewhat. The dollar has been able to move higher. Now, of course, if the Fed eases its policy lower and the interest rate goes lower in the US to 1.75%, obviously this means the interest rate differential between the United States and Japan will be going lower. And then in that scenario, we would expect the currency pair to push lower to the downside as the dollar weakens. However, if the interest rate doesn't go lower, then we shouldn't expect a weaker dollar against the Japanese yen. And you could say there's exactly the same situation for the dollar against the Swiss franc, which again had been getting weaker since around May on these rate cut expectations. But now we've seen a pullback, and now moving forward is all to do with the Federal Reserve. Are they going to cut rates lower again, or are they going to keep rates on hold as they are? And this will dictate whether the US dollar weakens or stays the same or weakens against the Swiss franc in the markets at the moment. So traders, with the dollar moving forward, it's clear to see it's the interest rate differential which is going to be a clean and clear driving factor for the dollar. So the dollar has been getting stronger against the euro at the moment. We now sit around 110 on the exchange rate. We know the European Central Bank's pumping more money into the European economy to try to stimulate growth, but at the moment, so is the Federal Reserve. So if you get below 110, this could signal further downward selling for the euro against the dollar. But again, what's happening with the ECB and what's happening with the Federal Reserve will be the key driver for this currency pair moving forward. We've already touched on the pound against the US dollar. We know that's going to be driven by Brexit. So that's the key driver for the pound, and it will continue to be the key driver for the pound against the US dollar. For the New Zealand dollar traders against the US dollar, at the moment, this currency pair is pretty much at our entry price, so it came very close to our stop loss, then turned back lower. So we're still in this position in the markets at the moment, in a tiny profit of around 25 pips or points. But if the Fed is not expected to cut rates any further, but the New Zealand Central Bank is expected to continue to lower its rates, then we could expect the New Zealand US dollar currency pair to continue to fall to around 0.60. So we are in a good position to profit from that exchange rate price should it continue to push to the downside. Looking at the Aussie dollar US dollar exchange rate, clearly we've been on a downtrend as the Aussie central bank has been cutting rates. But if the Fed is no longer going to cut rates and the RBA are going to continue to cut rates, we could expect this to continue to fall to the downside. And if we get below 0.67500 and we see more downward selling, this could be an opportunity for us to short this currency pair moving forward. And one of the key points that the RBA had been making to cutting interest rates was if the unemployment rate was going to go higher, continue to push to the downside. So if unemployment continues to rise in Australia, and if inflation doesn't, then we could see more rate cuts coming in Australia, and that does set up the scenario for a weaker Aussie dollar New Zealand dollar exchange rate, and then hopefully we can take a sell position should we get below 0.67 to the downside. For the short position we entered for the Norwegian krona against the US dollar, at the moment traders in a small loss in the position of around 279 points in the market. So it's only moved not even 0.5%. And at the moment, let's see how this plays out. But oil prices, of course, are going to have a key role to play in this currency pair. So I'm still holding this position, traders, for the US dollar Norwegian krona. And also we can look at the US dollar against the Canadian dollar, which is also driven by oil prices in the markets, and the oil price is going to be a key driver for this currency pair also. And I will do an oil analysis in the next video following this for you guys. So traders, I hope that makes sense. For the dollar, it's all to do with the Fed. What's going to happen with interest rates? If they cut them lower, then we could expect more weakness in the dollar against the yen, Swiss franc, against the pound. We know Brexit. We could see the dollar strengthen against the New Zealand dollar and the Aussie dollar should the Fed not cut rates, but the RBA and the RBNZ continue to cut rates. So we have to wait and see how that plays out in the markets. So traders, that's my analysis for the dollar. Thank you for watching.